Hello! On this occasion, I would like to explain about the results of our group discussion regarding the third case, financial ratio evaluation. Before that, let me introduce ourselves. My name is Gina, and my partners are Geski and Sujia. Okay, let's start to the discussion. So there's a company data given, current asset is 2 billion, current liabilities 1 billion, net income 1.2 billion, equity 4 billion, sales 6 billion, cost of goods sold 4.2 billion, and the last one is industry ROE or return on equity benchmark 18%. Okay, let's calculate the ratios. The first one is current ratio. The formula is current assets divided by current liabilities. So 2 billion divided by 1 billion. The result is 2.0. What it's mean, for every 1 Indonesian rupiah the company owes in short-term bills, it has 2 Indonesian rupiah in hand to pay it off. That's like having twice the money you need to cover your urgent bills. In short, very liquid. The next one is return on equity or ROE. The formula is net income divided by equity. So 1.2 billion divided by 4 billion. The result is 0.30 or 30%. What it's mean, for every 1 Indonesian rupiah invested by the owner, the company is making Indonesian rupiah 0.30 in profit. That's why above the industry average or 18%. And the last one is gross profit margin. The formula is sales minus COGS divided by sales. So 6 billion minus 4.2 billion divided by 6 billion. So the result is 0.30 or 30%. Same like ROE. What it's mean, out of every 100 Indonesian rupiah in sales, the company keeps 30 Indonesian rupiah after paying for the goods. That means they've got decent breathing room to cover all the other expenses and still profit. Furthermore, it will be explained by Geski.
Interpreting the ratios in simple words. Liquidity current ratio equals 2.0. PT Financia isn't just surviving, it's comfortable. Having a 2.0 current ratio is like saying, don't worry, I've got twice what I need to settle my short-term debts. It shows strong short-term financial health. Profitability ROE equals 30%. This is impressive. The company is doing a better job than most in the same industry at turning investments into profits. If other companies are jogging, PT Financia is running full speed. Investors would be excited about this kind of return. Efficiency, gross profit margin equals 30%. The company is handling its production and sales pretty efficiently. They still have 30% left from their revenue after covering the cost of making or buying their products. This is a sign of smart pricing and cost control.
Next, it will be explained by Sujia.
Benchmarking against the industry, the average ROE in the industry is 18%, but PT Financia is soaring 30%. That's a huge gap, and it means they are lacking doing things like managing cost well, making smart investment choices, operating efficiently, using resources in a sharp, focused way.
So these are all answers to the result of our project discussion. We are very receptive to criticism and suggestion. If there is a mistake in our words, we apologize. That's all from us. Thank you.